Investors are having deja vu. After a strong start this year, the economy and the stock market have slipped into a summer slump for the third consecutive year. But will the slowdown prove more protracted this time around? The Federal Reserve has certainly lowered its outlook for economic growth this year to 1.9% to 2.4%. That's down from its forecast of 3.5% a year ago. The Fed also lowered its outlook for the next year, projecting the economy will grow less than 3%, and is now forecasting the unemployment rate won't fall below 7% until after 2014. To boost economic growth, the central bank is doing the twist again, extending its so-called Operation Twist program through the end of the year. That program uses the proceeds from the maturation of short-term treasury bonds to purchase longer-term dated treasuries in an effort to further drive down long-term interest rates and reduce borrowing costs for businesses and consumers, ultimately to spur investment and growth. Here to weigh in on the Fed's actions and share their outlooks for the economy and what it means for the stock market are Doug Roberts, Chief Investment Strategist for Channel Capital Research and author of Follow the Fed; Hillary Kramer, investment strategist and editor of Game Changers, Breakout Stocks Under $10 and High Octane Stocks; and Fouad Ahmed, CEO of online discount broker Just to Trade. Welcome to you all. Doug, let me start with you. It appears we're in another summer economic slump. What is the risk that the economy stalls here, or even worse, relapses into recession?
I think the key here is government stimulus, whether it be monetary or fiscal. Fiscal tends to have more of an effect on the economy. So another thing that probably, now that it looks like Europe, at least for the moment, and I do mean for the moment, seems to be stabilized, is really whether they're going to resolve basically the so-called financial Armageddon situation occurring at the end of the year with the expiration of the Bush tax cuts and a lot of the incentives, and basically force fiscal austerity. If that happens, then we can possibly move from there. But that'll be the next thing up on the agenda, and it'll require more fiscal stimulus rather than monetary stimulus coming up. The Fed, in the meantime, may try to smooth the situation by doing some type of additional noises about quantitative easing, but really that depends.
Hillary, what's your outlook for the economy? Do you believe that excess stimulus from the fiscal side via Congress is necessary at this juncture?
Well, I do believe, Jennifer, that it's necessary in order to jumpstart and keep the stock market on an upward trajectory, which is so important. When we stalled out after it looked like we really had caught a bid, it's been very, very disconcerting for individual investors as well as for Wall Street. When I look at, in the past 2 weeks, the number of layoffs that I have personally noted that former colleagues and friends of friends have suffered at some of the larger investment banks and certainly many of the boutiques that are even just shutting their doors, it tells me that we do need the stimulus, and we need it because it'll help get our stock market going. Don't ever underestimate the value of the fact that Apple, rode all the way up to above $600 a share, and what that did to the optimism and excitement on Wall Street, in the tech sector, and with individual investors that had mutual funds, ETFs, and Apple stock itself.
Fouad, what's your outlook as the CEO of a discount online broker? What do you see now?
I think I'm going to be a little bit more bullish than some of our analysts. What I feel like is you obviously have stimulus from Fed earlier last year as well. Mm-hmm. What we see is Just to Trade, especially on our customer side, there was a lot of cash on the sideline. Mm-hmm. And what we have seen in the last quarter is a lot of that cash being put to work, in particular ETFs and a lot of equity stocks, a lot of equities. And what I feel like is going to be what's happening in Europe, in particular, is having a lot of effect on the U.S. markets on a short-term basis. On a long-term basis, if you look at corporations, they have a lot of cash. They are flush with cash, and they have unfortunately laid off a lot of employees as well. Mm-hmm. So the next, especially summer and fall, and when we go to the fourth quarter, it's going to be more wait and see what happens in Europe. And at this stage, I personally feel like Fed is going to be on the sidelines.
Doug, getting back to your point about more stimulus that's necessary, what would you like to see from Congress, from the fiscal side? And also, do you think that monetary policy has reached a saturation point? Should the Fed continue with its unconventional policy and roll out a QE3, if you will?
I think it's going to really be more important in the message the Fed sends in the next policy meeting. I think as long as the situation stabilizes, you don't have any major shocks. You can kind of have more of what you saw last year, where basically the Fed has said if it's necessary, they will do something to stimulate the economy. The real danger is not so much, I guess, whether they stimulate or not, but the degree of stimulus necessary to neutralize. If you go back to 2007, when the fiscal crisis first started, the Fed was easing fairly aggressively, but it was not enough to diffuse the crisis. Right now, I think what the market's probably looking for from Chairman Bernanke is some type of an indication as to what form QE3, QE 2 3/4, whatever you want to call it, will take, and under what circumstances it will be released. The Fed chairman, on the other hand, wants to keep his options open, so he's trying to do just enough to basically prevent people from losing confidence in him and thus taking the market down. Those so-called rumors that you had before that the Fed was going to run out of bullets is definitively not true.
Do you think he's reserving that in case there are some spillover effects from Europe?
Yeah, I think definitely. What he really wants to do is he wants to do just enough so that it doesn't become a self-fulfilling prophecy that he needs to add stimulus unless it's a geopolitical event. Now we focus on Europe, but another thing that people really haven't focused on is there is a slowdown in China. And China, I guess, to quote Winston Churchill, I believe, said about China that China was really an enigma wrapped in a riddle. Nobody's really sure of the numbers coming out of China, so at that point, given that there has been some indications of at least a power struggle within the party structure there, nobody's certain what's going to happen there. He might be waiting for that. And we also see a great deal of uncertainty for the Middle East. So I think he prefers to, if you want to call it, keep his big guns in reserve until something like that happens. But in the meantime, he is walking softly and making sure that everybody sees that he's carrying quite a big stick.
Hillary, how does your outlook for the economy tie in with your outlook for corporate earnings and the stock market?
I'm concerned that the European crisis is actually affecting and impacting some of our biggest companies. And this has been my fear. So even though I feel that ultimately the U.S. equity market will be flight to safety and flight to quality, let's take a look at specific examples. Ford and McDonald's. McDonald's was on its way to being well over $100 stock. It's trading in the high 80s right now. What's the overhang? Europe. You take a look at a stock like Ford that made an announcement that their European operations and a slowdown in purchasing was going to have an impact, on earnings, and that they were going to make decisions about certain plants in operation in Europe. This is really serious to me because until now, the European problem has not really had contagion beyond just the fear factor and the unknowns that, of course, an interwound global market has to deal with. But now it's about our own companies and the impact that we're going to see. And so I am a little bit concerned about specific companies that are global, U.S., and what will happen when we go into earnings.
Vlad, what catalysts are you watching in terms of the market?
I think a couple of key things. Dollar. See, the dollar continues to strengthen versus euro. And obviously, other thing we're seeing is commodity prices, except today, oil was up close to $6, but it's down to mid-70s. I think those are the key things that we need to keep an eye on. Obviously, we keep talking about Europe, but I think the other thing we have to look at, what Doug was alluding to earlier, is in China. The property values, they've started to slow down. And we have to see how is that going to have an effect on the banks in China as well. Are we going to have another issue like what we're seeing in Europe, in China? But in China, the other thing we see is the numbers that like I was talking about earlier are not really. There was an article last week in Financial Times, I believe, where they were talking about the numbers that are coming out of China. How accurate are they? So the potential financial crisis that we see in China could be bigger than what we see in Europe. So,
really?
But, yeah, and that's my opinion. I see it because look at the property boom that we saw in China. And that was the biggest fear that we had was we continue to see a very rapid rise in property values in China. Now what we're seeing is them basically slowing and now coming down. So that is the unknown.
All right, Doug, quickly, where are you investing now?
Well, right now, I mean, what we found in basically our models is we believe that the Fed is, right now in a negative interest rate environment and will continue to remain there. Given that he's going to continue to stimulate monetarily, the two sectors that benefit the most from that are gold versus bonds and also small cap stocks versus large cap stocks. I think Hillary is correct in what she's saying, and that a lot of this turmoil can have effects internationally. However, as long as there's enough stimulus and we don't get a breakdown of our credit and financial system in this country, that may mean that the so-called larger multinationals will start to experience problems, but smaller companies will continue to do well. We're starting to see that somewhat in the energy sector as well right now with some of the substitution for natural gas for petroleum products. Another area that could be universal in this type of environment or could continue to have a large run is really technology, because technology solutions are productivity enhancing by nature.
All right, Hillary, could you, we're about out of time here, could you name a couple of companies that you like right now?
Yes, Suburban Propane, SPH, a northeastern United States propane supplier. The dividend yield is 8.26%. Excellent company. Very difficult to change from propane back to any other form of energy once you have those big tanks in. I also love Evercore Partners, EVR is the ticker symbol. There you have approximately a 3.5% to 4% dividend yield. This is a boutique investment bank that doesn't have to deal with the same regulatory issues and a lot of that 2008 and 2009 overhang. And I expect that we're going to see mergers and acquisitions come back. Evercore does M&A, mergers and acquisitions, as well as is growing asset management and has the right political connections. The stock has really been stuck along with the whole sector, and I think there's huge opportunity there. And third, I really think now is the time for biotech. 10 years, even 15 years later than anyone expected, but we're finally at the time where these biotechnology companies are producing real next generation products. I like Regeneron, REGN. This is a company that could be acquired at $175 a share and trades in a very volatile range between $110 and $115 a share right now.
All right, thanks very much, Hillary, and thanks very much to all three of you for being with us.
Thank you.